All right, welcome to The Explainer. Today we're going to tackle a huge one, a company that's incredibly influential and, let's be honest, pretty complex, the Chinese tech giant Tencent.
And we're not just going to list facts. We're going to frame this whole thing around a single, really interesting question. Could one of the biggest tech companies on the planet actually pass Warren Buffett's ultimate test? Is it that good of a business?
So first things first, let's talk about that ultimate test. We're going to put on our value investing hats, think like the pros, and really see if Tencent's business quality is as solid as it seems.
But before we can do that, you've got to understand the sheer scale of what we're dealing with. We need to step inside what you could call Tencent's digital kingdom. Seriously, the power this company wields is just immense.
And it all starts with this one absolutely staggering number, 1.3 billion. That's how many people use Tencent's main platform, WeChat, every single month. Now, if you're not in China, you might think it's just another messaging app. No. It's basically the entire internet in one app. You chat, you pay for your coffee, you book a doctor's appointment, you get your news, all of it. This user base, this is the bedrock of Tencent's entire empire.
Okay, so you have over 1 billion people's attention. How do you turn that into money? Well, Tencent has a pretty brilliant answer. They would build this sprawling business on top of that user base, and it all boils down to 3 core pillars.
And here's how that revenue engine breaks down. Look at this. The biggest piece of the pie, a whopping 52%, comes from what they call value-added services. Now, that's the fun stuff. Think video games. They're the biggest gaming company in the world. But it also includes things like social media subscriptions. Then you've got 30% from fintech and business services. This is huge. It's their payment system, WeChat Pay, and their cloud business. And finally, 18% is from good old-fashioned online ads. So you see, this isn't a one-trick pony. It's a seriously diversified machine.
All right, so an empire that big, you'd expect a beast of a financial engine, right? And you'd be right. But Tencent's recent story isn't just about smooth sailing. It's actually a story of getting hit by a massive shock and then showing some incredible resilience.
Just look at this chart. It tells a really dramatic story. Back in 2021, net income was flying high. Then, bam! By 2023, it got chopped nearly in half because of some major external pressures. But look at the rebound in 2024. The ability to take a punch like that and then get back up and start growing profits again, that tells you a lot about the underlying strength of this company.
But you know what's maybe even more impressive? Even with all that volatility in its profits, here's the real kicker, the truest sign of quality. For the last decade, Tencent's free cash flow margin, that's the actual cash it generates from its operations, has been over 20%. Every single year. That, my friends, is the definition of a cash-gushing machine.
Okay, but let's not get carried away. No analysis of Tencent would be honest without looking at the major risks, the very things that caused that profit dip in the first place. And these aren't just little bumps in the road. We're talking about some serious storm clouds on the horizon.
The biggest storm really hit back in 2021. That's when Chinese regulators launched this massive crackdown on the entire tech industry. For Tencent, it meant new rules on how they could operate, but the biggest blow was a 9-month freeze on new video game approvals. Remember, that's their #1 moneymaker. Now, approvals are back, but the whole game has changed. The relationship with the government is just different now.
And look, that regulatory issue is just one piece of a much bigger risk puzzle. You have to understand, Tencent is constantly dealing with government oversight. They have ferocious competition, especially from ByteDance, the company behind TikTok. Their main market, China, is basically full. They've already got everybody. And on top of all that, you have the ongoing geopolitical friction between China and the West. These aren't problems that are just going to disappear. They're structural. They're part of the deal.
So, let's pull all this together. What do we have? We have an incredibly high-quality business that just gushes cash, but it's also facing a wall of very, very real risks. So, how does it actually score on our test? And maybe the most important question for any investor, what is this thing actually worth? All right, let's run it through a quick, simplified, Buffett-style checklist. On the quality side of things, it does really well. Generating tons of free cash flow? That's a definite pass. High average return on equity? Yep, pass. Strong gross margins? Pass. Not too much debt? Another pass. But where does it stumble? Earnings consistency. That huge dip we saw in 2023 means it fails the test for smooth, uninterrupted profit growth. So you see, it's not a simple yes or no. It's a nuanced picture, a fantastic business that hit a major speed bump.
And this leads us straight to what is arguably the single most important concept in all of value investing, the margin of safety. The idea is actually really simple. First, you figure out what you think a business is really worth, its intrinsic value. Then, you only buy it if the stock market is selling it to you for way, way less. That discount, that gap, that's your margin of safety. It's your buffer in case you're wrong or just get unlucky.
So, what's Tencent's intrinsic value? Well, if we run a discounted cash flow analysis, we get a pretty wide range. In a super conservative scenario, let's say with zero growth from here on out, you get a value of maybe $26 a share. But what if you use a more nominal case, one based on its historical growth? Well, then the value looks more like $135 a share. Now, compare both of those to the recent market price of around 71 bucks. That gap, especially to the nominal value, is, well, it's huge. It suggests the market is pricing in a lot of pessimism.
And hey, don't just take my word for it. As one financial research report put it, and I'm quoting here, Tencent's intrinsic value appears substantially above the current market price under reasonable growth expectations. Basically, if you think Tencent can just keep growing at a pretty normal pace, it seems like it's worth a lot more than its current stock price.
And that really brings us to the final big question. Tencent is the classic investment puzzle, isn't it? You have a truly world-class business, a dominant force, but it's facing world-class risks. The market is clearly offering a discount for those risks. So the ultimate question for any investor is this: is that discount big enough? That's the billion-dollar question you have to answer for yourself. By the way, if you want a tool to help you track the overall market temperature, you can search for and download an app called the Buffett Indicator right from the iOS App Store. It's pretty neat. And just a quick reminder, everything in this explainer is based on public information and it's for educational purposes. This is not investment advice, so please always do your own homework. If you enjoyed this breakdown, make sure you follow the Explainer channel for more. Thanks for tuning in.